Hey, welcome to Woody's Weekly Wisdom, episode number 65. It's Andrew Woodward here from the Investor's Way, and going to go through some of the latest data coming out of Australia. And so before we dive into the big headline, do me a massive favour, hit the like button, the share button, or the comment button, or all three if you're watching on LinkedIn or Facebook. And if you're watching on YouTube, hit that little bell up there to get notified when these videos come out. Smash the subscribe button so that we can grow the audience. More people can see what we're doing and learn about financial literacy and how to interpret what's going on in the markets and how you can use that to manage and grow your money. So today we're looking at this headline down here: worst in 30 years, horror news for Australia. Now, if you saw that headline, you'd be like, what the heck is this horror news for Australia? Worst in 30 years. So it's got to be pretty bad, right? So we come across and we have a look at the actual article, and we get to see that this headline has been changed to the more sedate GDP figures for June quarter show growth at 0.2%. So what's the horror news? What's the worst thing in 30 years? Why is it so bad? Why should I be panicking? Well, the simple result is that, in fact, there's nothing in this article to suggest you should be panicking. But let's go through what the report and the data and the article is actually telling us. And there is an element of it that is the worst in 30 years, but it's not quite, horror news or news that should generate the type of fear that headline would generate if you just glance the headlines. And let's face it, that's what 90% of people do when it comes to the media headlines. They see the main headline, see what whether or not that interests them to read it, and something like that. I'm assuming for a lot of people that just go on more horror news, don't need that, I'll move on. But let's have a look at what it is. What is this horror news? And so it's in this headline showing you that our GDP, so our economy, the Australian economy in the June quarter showed growth of only 0.2%. Still growth, but only 0.2%. So if we scroll down here, and we can see that the worst in 30 years is that growth rate of just 0.2%. But there's a lot more to this 0.2% than just the headline number. And let's have a look at what that is. And so what we've been talking about on these weekly wisdom videos is this whole economic growth, inflation, interest rates, and how they're all intertwined. And the thing that has been a bugbear of these weekly wisdom videos is that the government, or more particularly the Reserve Bank, because they are supposed to be independent, but the Reserve Bank has been using interest rates as a sledgehammer to stop us from spending and get the inflation rate down to their target zone of 2 to 3%. And what we're seeing with this 0.2% growth in the June quarter is that sledgehammer has well and truly hit the mark. Because what we can see here is that, well, before we dive into it, I'll just make sure I tick off this metric here, and that's showing you that our economy for the last 12 months has grown at a paltry 1%. And so that's not great, but it is still growth. And if you come from the idea or from the perspective of growth is still, some growth is better than no growth, then absolutely 1% is better than zero, and certainly better than negative growth, which, if we get that for a couple of quarters, we're in a recession. So that's all well and good. So we've got 11 consecutive quarters of growth, which has kept us out of the fears of a recession. And so what this data has actually told us, and this is the bit that I wanted to get to, is that household spending had actually fallen by 0.2%. and taken 0.1 percentage points from that GDP growth. So what that's saying is, and it's outlined in this article further, that the actual growth in the economy has come purely from government spending, because households, like they've been told for the last 12 to 18 months by the Reserve Bank continually increasing interest rates, is you must stop spending in order to bring inflation down. And then in order to keep the economy growing, the government has been spending. And, it's a lesser of two evils here. Do we want a recession or do we want lower interest rates? What's the priority? And throughout this article, there is, and it's alluded to further on in the article, that there's a little bit of tension between the government and the Reserve Bank because of their different perspective of what priorities should be right now. And so the government obviously copping a lot of flack because of the high cost of living, the high interest rates, and people under a lot of stress. And the Reserve Bank basically saying, well, you've got to stop spending, households, so that we can bring down inflation before we'll do anything on the interest rate side of things. So a couple of competing, objectives, and that is leading to a little bit of tension between the government and the Reserve Bank. As much as they're both denying it, it absolutely is going to be there, because in the not too distant future, we're going to be talking about an election, and there's a possibility that the government will be punished as a result of how they've managed the economy. So that's a different story, maybe a different weekly wisdom, but ultimately this is a telling part of this news story, in that household spending is falling, government spending is increasing, and that has led us to having a small growth in the economy for the June quarter. And so, we look at, that was the pandemic, so they tend to exclude that. So this one here was the pandemic, so they tend to exclude that one. But just showing you that for the last 11 quarters, we've had growth, but as you can see, it's very, very minimal in most cases. So we're just hanging on and just ticking by when it comes to the fears of a recession. So as I said, the government saying any growth is welcome, irrespective of how we get it. And we understand that, households are under pressure, but we're doing really well when compared to other OECD economies, where they've been going backwards, and we've just been continually growing. So that's all factual, but at the same time, it's all political talk, because at the end of the day, what people feel is what's going on in their household. And as it says here, the cost of living pressures are still acute. But the government's trying to say they would be worse if it wasn't for the spending that they're doing to help things tick along. Maybe they're right, maybe they're not. But as the Reserve Bank keeps saying, with inflation at 3.8%, hold those thoughts when it comes to a potential interest rate cut. So that is also going to be interesting to see how that plays out, because we've got talk in the US of a potential rate cut as soon as September this month. And here we have, in a separate article, but today, as soon as this article comes out, we've also got a story coming out from the Reserve Bank governor saying, don't get too carried away about this discussion of a rate cut. Inflation is still too high, and so that rate cut is not coming too soon. And her solution for people who are struggling is maybe you have to sell the family home, which is obviously a very... it's just not what people want to hear, and it's certainly not the solution that people want to have to deal with. And that's kind of like missing the mark when it comes to the message that you want to hear from the Reserve Bank. So there's that statement, unlikely to see a cut before or at the September 24 meeting. And that's probably expected. I think the US is in a much better position. Their inflation is much lower than ours. They're a lot quicker at getting under control. And so we'll just see how we go. But the moral of this story is the households have done their job and cut their spending. And maybe it's time that we got that inflation number, or saw that inflation number come down. But we haven't seen it yet. And so the powers that be are hanging on. and they want to continue to hit us with those high interest rates. So, as I said, inflation is still up at 3.8%. The target for the RBA is between 2 and 3%. And so no relief on the interest rate front in the short term, according to them. But it'll be very interesting to see how their tune might change if we see a big drop in that inflation number in coming months, because our spending has just dried up. And now we're in that difficult predicament where the government has to manage the economy to ensure it keeps growing, because nobody wants an economy that is shrinking. That doesn't help anybody either. And therefore, you're going to have some very difficult government and RBA conversations about how to manage what they call the landing of this interest rate cycle, and try and ensure that we don't go into recession. So 11 quarters of slight growth. There's a couple there that were reasonable growth, but generally speaking, at least in the last 4 quarters, the growth has been marginal at best, above zero at least, but marginal. And so the economy certainly is not racing away in terms of inflationary impact. And therefore, I think in time, we're going to see that come back. The biggest problem, obviously, and we've talked about this a few times on these videos, is the housing crisis. And that is a little bit of a self-fulfilling prophecy. When you have interest rates so high, landlords are going to pass that on in the form of rents. And therefore, there's a flow-on effect of those costs into inflation as well. So, ultimately, we've got an economist from Deloitte basically saying that households are already in a recession, and that we need to see more action from the government to help, in whatever way it can be. The government saying, well, that doesn't help anybody, being so negative, and so on and so on. But the Deloitte economist, was talking about how they believed that the last interest rate increase that we got in November 2023 was one too many, and now we're paying the price as a result of that. So I've said this many, many times that whether it's the RBA or the Federal Reserve in the US, they always overshoot the runway on the way up, and then they're slow to bring rates down. And as a result, we're seeing the impact of that now. And it really is going to be a tough job to see how the Australian economy trades out of this scenario. And there we have it, inflation down from the peak of 8.4%, down at 3.5%. And hopefully we'll see another dip. And that will start to give the RBA some confidence that they can bring interest rates down. And there you can see that massive, rapid rise from 0.1% all the way up now to 4.35% for interest rates. We certainly don't want to go back, and will not be going back to the 1990 levels. But that sharp rise is just really starting to bite for a lot of people now, and we're seeing a lot of stress in household budgets, and so that is difficult. And we need to see how the government will respond to that. Now, what does that mean for your money, your wealth? Well, it's a difficult one, because we had been hoping to see a cut in interest rates, and we're not seeing it in the variable land, but we are seeing it in the fixed land, which I talked about on last week's call, last week's Weekly Wisdom. So I think there still is the possibility of a rate cut this year. The last meeting will be November around a Melbourne Cup, as it always is. And it'll be interesting to see if there's a possibility by November of getting a cut. But if that's not the case, then it's more than likely going to have to wait until February. And that, for some, might be too late. So interesting to keep our eye on that. But I guess the key here is that we should not be panicked by these extreme headlines. The economy is growing marginally, but growing. Our spending has come down, household spending has come down, and that's going to flow on to inflation. And ultimately, we're going to see a cut in rates. and that should free up some capacity for people to have more for their day-to-day living, and that will bring some confidence back into financial markets as well. So just a little bit of more of the same, but wanted to highlight just again the extreme nature of the headline versus the actual data, where the headline was a horror story, and then the real headline was, oh, we grew again for another quarter, for the 11th quarter in a row. So hard to correlate the horror news with the news that we'd grown for the 11th quarter in a row, which was better than most other OECD economies. So hopefully that's helpful. Leave me a comment. Let me know if your thoughts or what your thoughts are on this story, this news. And like I said before, if you're watching on YouTube, hit the bell, smash the subscribe button so we can grow this channel. And if you're watching on Facebook or LinkedIn, hit the like button, leave us a comment. And if you want to share this with some friends, that'd be great too. And let's spread this news so that more and more people become desensitized to the fear of headlines and can use that to their advantage when it comes to managing their money and growing their wealth. Take care. Have a great week. See you again next week. Cheers.